Hello, and welcome to Mayor Brown's podcast series, Credibly Challenged. This podcast focuses on risk management issues for financial institutions of all sizes, particularly those in the banking sector. My name is Matt Bisanz, and I'm a partner in Mayor Brown's financial services, regulatory, and enforcement practice. Joining me today is Robert Kidd. Robert is a bank regulatory counsel at Capital One and has an illustrious career in many different risk and legal-related roles, including in the government. On today's program, we'll talk about the experience that he's gained from those different roles and some of his thoughts on the intersection of law and risk. Thanks for joining us, Robert.
Matt, thank you so much for having me. You and your team and Mayor Brown have been wonderful advisors to Capital One over the years. So when you invited me to join you, I was proud to do it. Thank you.
Thanks. So to get started, how did you originally become involved in risk management? I've seen a few different roles in different agencies, but tell me what got you started?
Yeah, no, thank you for asking. I got started actually in law school. I had bumped into a friend of mine who was dating someone who was a bank examiner at the Richmond Fed. And I was a second year law student at the time. And they were describing what they did at the Federal Reserve. And I thought, that sounds terrific. I was, prior to going to law school, I was in consulting. And very similar to consulting, a bank examiner spends 2, 3 weeks of their time in a different community bank or a different financial institution and engaging with management, understanding their processes and how they do things. And that sounded fascinating to me. And so I immediately, the next day, reached out to the Richmond Fed and said, I want to be a bank examiner when I graduate law school. And they said, you know what? We have actually an internship here beginning in the fall. Why don't you join us as an intern in our region focus, in their publications unit, writing for the Region Focus magazine. And that's what I did. So I knew during my third year of law school that I actually wasn't going to be practicing law the following year. And I was going to be examining banks. And I thought that, Matt, one day I would eventually practice law and I'd practice banking law, but I felt like I needed to understand context and how banks actually, um, engaged in business. Like, what were the ways in which they went about their business? And that would, you know, allow me to advise an organization as a lawyer in a far better way than I thought that if I had just started advising a bank right out of law school without really understanding what they did. And so that's how I got into risk management.
Yeah, great. And has that come to pass? Have you been able to use some of that experience and those skills from your days as an examiner at the banks you've worked at?
Every day, every day. I'll say, because I do advise our risk management and our audit teams primarily. And so, for example, my area of focus really has been over the last several years heightened standards guidelines, third party risk management, AML, BSA to a limited extent from a risk management perspective. Now, climate risk, I'm sure you've heard of it, getting more and more play, recovery and resolution planning. And so those were all areas that I examined banks. And so now in my practice, having an opportunity to start with and share context and background before getting into, the legal technicalities of a given law, but being
Hmm.
able to explain to our business partners why, what are the examiners or what is the background behind this regulation? And
Hmm.
then let's talk a little bit about the legal analysis and how we can arrive at an answer that gets the business well positioned to comply with the law.
Hmm.
We think it starts with context first. And so
Right.
just being able to have that background to draw on, I think has been helpful.
Right. And now you mentioned heightened standards as one of the laws out there that prescribes risk management practices, but there aren't actually that many laws that prescribe risk management. That's kind of
You're
an
right.
exception out there. When you're looking to iterate out into other areas or things that aren't covered in heightened standards, what do you look to as the basis for your advice, or sort of what's the way you develop the practices that your institutions will use?
That's a great question. The first place that I go to when I don't think that there's a law on point is
Mhm.
actually I defer back to my training as an examiner and I look at the examiner handbook. Let me give you like a real life example. I've been advising some of our internal uh, business partners on concentration risk. Concentration risk is mentioned in heightened standards, but it's not defined in regulation anywhere. But if you go back to the handbooks, the Corporate Governance and Risk Governance Handbook that's published by the OCC, they certainly mention concentration risk, and they touch on the concept in different ways that I've been able to then, you know, provide and share with my partners to say, look, this is what the examiners are getting at or thinking about when they're thinking about risk concentration. And so I will often start there. Again, we all know that handbooks are not enforceable law. They're not something that we should necessarily oversteer toward, but
Mhm.
they certainly are a treasure trove of good background. The other place that I like to go to when I'm advising on risk management is, of course, we have the regulation, heightened standards 12 CFR Part 30 Appendix D. But remember when they proposed the rule and talked about the context and the things that they were trying to solve for? Well, I
Mhm.
like to actually go back to reading the preambles of
Mhm.
proposed rules, and I look at comment letters, and then I look at also then once the rule is finalized, going back to the commentary and the preamble as well.
Mhm.
And oftentimes they touch on broader concepts, right? How a particular reg may fit into the broader landscape.
Mhm.
And so those are often sources that I'll go to make sure that I'm considering the topic as broadly as I possibly can before narrowing in on my advice.
Mhm. That's great. It sounds like you're really weaving a tapestry to provide some beautiful and strong advice to your internal clients. One thing that can sometimes come up where when lawyers are putting together that complex advice where there isn't a bright line answer, or the copy paste answer, as I like to call it, is someone will decide they want to second guess us on it, and particularly if it's something where we know we can't point to a regulation on it that will embolden others to second guess and say, well, it's no longer just a legal issue, it's also an interpretive, or it's also a business issue. And this I've seen it come up, particularly with some of the lines of defense, say internal audit, because their job is to go around and second guess a lot of the parts of the bank, even though they may not be lawyers, or even though they may not be risk professionals. How do you manage the relationship with particularly the third line to minimize the second guessing, or maybe educate them as to why your professional judgment is an expertise that is they should respect?
Matt, easier said than done.
Hmm.
I think that if you think about structurally where legal falls within the risk management framework, right?
Hmm.
And you've got the three lines of defenses. In my opinion, and again, these are strictly Robert Kidd's opinion on the matter and not, Capital One's position
Hmm.
necessarily. But I agree with the view that legal falls outside of the technical three lines of defenses and that we advise each of the three lines um, equally, right? Our client is the corporation, and each of those units, you know, deserve to receive our advice unfettered, independently, and only lawyers, frankly, have a license to practice law and provide interpretations of law. That's my belief. And as a result, when auditors question the legal interpretation by a lawyer, we've at least made it very clear through our Capital One legal policy that
Hmm.
those interpretations remain the purview of legal and legal only. And so even though we may have lawyers who are very, very good lawyers who are trained and even licensed who fall outside of the legal department, unless you report up to the general counsel or through the general counsel, um, providing legal advice remains the purview of those individuals. And so that gets us like 85% of the way there. And I'd say the remaining 15% is really working to um, maintain and build credibility with those auditors, with risk management, again, to show them and influence them through context,
Hmm.
right? And understanding. We may have a difference of opinion, and that's perfectly fine.
Hmm.
However, I'm making my legal judgment based on well documented rationale based on this context. And by the way, if we get it wrong, I'm accountable and responsible.
Hmm. Yeah.
And and so I think that gets us the
Hmm.
remaining from the 85%, structurally, then to the
Hmm.
100%. And there are cases when we're second guessed. And by the way, that's okay.
Hmm.
Um, I personally don't have a problem with other associates who are outside of legal challenging, providing effective challenge, right, to
Hmm.
legal advice. I think it makes our legal advice better when
Hmm.
we're challenged. Also, um, Matt, I'd be misleading you if I said I've never been wrong, right? I've been wrong in my analysis at times, and at times when I'm challenged, that will just make my analysis better.
Great. So, turning to another topic from your past, um, you were a chief risk officer of a smaller financial institution. Could you tell me a little bit about that role and how that role differed from this much more sophisticated or complex role of being in this very large national bank?
Sure, happy to. You're right. So back in 2010, 2011 timeframe, I left the Federal Reserve as an examiner and went to become a vice president and chief risk officer of a community back in Delaware called the First National Bank of Wyoming. It was a $300 million community bank in asset size, 5 or 6 branches located in Kent County. And I was their first risk officer. They had never had a chief risk officer before. And they were coming into the throes of sort of the jet wash of the financial crisis, right?
Mm-hmm.
2010, 2011 timeframe was really tough for a lot of community banks. Banks were failing every Friday. Community banks, the FDIC was resolving banks every Friday. And while we were a very strong picket fence rated, Camels rated institution across the board, um, I think they knew that the environment had changed and they needed some help, and
Mm-hmm.
they were right. That organization, although it was a 100-year-old national bank, is no longer there. They were acquired in 2014 by a company called WSFS out of Wilmington, Delaware. But I was not prepared when I walked in to see just how outgunned they were with
Mm-hmm.
respect to when the OCC came in. And they conducted, I joined in March and their examination was in April. And so we had a month to prepare for the exam that was coming. And it was a very, very tough exam. And what struck me was I always understood that community banks didn't have the resources of larger regionals or
Hmm.
larger banks, but I just didn't appreciate until I actually was there just how limited those resources are. And also what struck me was, a community bank has to be so much more careful with its resources.
Hmm.
Um, Smaller mistakes can become really, really big mistakes in a hurry relative to their capital levels,
Hmm.
relative to their liquidity. And that's precisely what happened to First National Bank of Wyoming. Wonderful organization. Like I said, it had been there 100 years old. They clearly did something right and they were really good at what they did. But again, they just got caught in the financial crisis. I'll
Hmm.
give you an example. Um, Community banks at that time really were um, into because of the mortgage boom, right? They were doing a lot of lending in land development loans, right? You have a lot of farmland in Kent County, and there were a lot of developers who were coming in and really bidding up farmland to then develop and grow houses, if you will, right? And those appraisals um, were really, really difficult, right? And we had, for example, farmland that would be appraised at say $9 million, right? When all is said and done, and a community bank would go in, and even if it lent only $2 million, really solid LTV, very low LTV, but once that development goes under and it doesn't come to fruition, then the farm gets reappraised. If it's a troubled loan, it gets reappraised. And we had a number of farmland that went from, say, a $7 or $8 million appraisal down to a $900,000 appraisal. So once you had, right, you
Hmm.
thought you were in a really strong LTV position.
Hmm.
Now all of a sudden you're in the throes of the financial crisis. Land isn't moving. Everything gets written down. That goes right to capital, right?
Hmm.
That's a
Yep.
hit. That write down is a write down right to capital. And that
Hmm.
happened more than once. And unfortunately, First National Bank of Wyoming had experienced that a couple of times. Now, granted, it had incredibly strong capital levels. It did not have to sell. It was
Hmm.
not a distressed sell by any stretch of the imagination. But I think they realized that in order to compete, in order to grow, in order to best serve its customers in Kent County,
Hmm.
it needed a bigger organization behind it to continue to thrive, and
Yeah.
that's what the board decided to do. Um, you contrast that with Capital One,
Hmm.
right? That has a far broader geographic area in which to draw business. For example, it doesn't have to concentrate in a certain geographic area.
Hmm.
And so you have a much broader breadth of resources in which to draw from as well. And so that's been for me the biggest difference.
Very cool. Well, one thing you were explaining there that really resonated for me was when you talked about how the farmland in the example could decline in value so much um, because of events beyond the control, really, of the borrower or of the bank, that it's not even something you could predict. Of people are still moving out there; it still is a desirable place to
Yes.
live, but moving at that specific time to that specific area, the failure to do so is can really impair a loan. And that made me think of some parts of ESG risk or climate risk that we can see the direction the arrow's going in with climate change, and we have some ideas of where it will or won't affect. We have some rough ideas of scenarios that might play out, but we can't say with mathematical certainty, well, tomorrow this loan will be worth $100,000 less, or this market will decline 8% over the next 10 years. And that's something I think people like you and me and particularly many of the quantitative experts are trying to get their hands around. But is that type of ESG risk something that you're starting to confront or think about, and maybe where does it fit into your risk advice?
It certainly does, Matt. We are right now in the very, very early innings of considering how climate change impacts, our overall risk profile. It doesn't mean that we haven't ever considered those factors, right? Like,
Hmm.
particularly if you are doing, real estate lending in certain areas, geographical areas, or have, a concentration of your physical plant or your branches in certain areas that may be prone to weather related impacts. And so I think it's always been on the back or in the back of our minds. But we are certainly thinking about climate risk. I think that it's important that as we develop those those muscles, that we don't do something that creates either unnatural acts to our existing risk management program, that we incorporate climate risk and the identification, measurement, monitoring, and controlling of those risks consistent with our risk profile, or excuse me, our broader ERM risk framework. um, and and I think only when we do that or take that approach will we be able to do it in a robust way or in a positive way. My sneaking concern, if you will, is with the focus of climate risk being so topical today and so important today, that
Hmm.
in the interest of having an answer to the case, we develop something that's sort of a standalone, sort of more siloed risk process that doesn't really integrate well with how we
Hmm.
do risk otherwise. And I don't think we're going to frankly do it very well
Hmm.
if we take that approach. I just hope
Right.
that the regulators and our investors give us the breathing room to
Hmm.
develop the data, develop the tools, to develop the processes in the right way and take the time that we need. Now, I
Yeah.
think that's a little bit wishful thinking. I don't think we can just sort of take all the time we want. But
Hmm.
I think if we do it diligently and effectively, we can get there. Um,
Hmm.
but I don't think we should do it in a standalone fashion that's artificial.
Well, I certainly do hope we get it right. I'm there with you on hoping. I can't see the path to it, but doing it the right way is going to be a lot less painful than doing it the wrong way in either direction. So.
Matt, I will say this for the OCC.
Mhm.
I was one of the supporters of the most recent guidance. I like the way the OCC is approaching it.
Mhm.
We thought that, if you substituted the word climate risk or climate related risk in the guidance for like
Mhm.
credit risk
Mhm.
or some other term, like you can absolutely see the connectivity between what they're proposing as guidance with heightened standards,
Mhm.
right? And
Yes.
I think the OCC has been very humble in their approach so far with allowing the industry to develop tools, and they've been very humble in reaching out, right, like publicly,
Yeah.
um, about trying to gather the wisdom of the crowd to solve this issue. My biggest concern is, again, short-sightedness where we rush, but also then overly prescriptiveness as well,
Mhm.
because I don't think that's good either. I think
No.
we are going to need to um, evolve.
Mhm.
I think we're going to need to experiment. We're going to need to fail,
Yeah. Yeah.
uh, frankly, right? And
Right.
be allowed to fail, yeah, of
Right.
course, in a way that doesn't jeopardize the safety and soundness of our institutions.
Right. But there are certainly things around the type of climate reporting that the OCC, I think in their questionnaire they sent to institutions, they listed 7 or 8 different frameworks that people have been reporting climate disclosures on. And I mean, I think I hope we don't keep have to continue to have 8 different reporting frameworks that find out which ones work, which ones don't, see which ones are useful. That's a great example of where experimentation will help lead to a result that we will all find more useful, more informative, more actionable. So
That's right. That's right.
yeah,
And Matt, the other piece of this, we'd be remiss if we didn't talk a little bit about the SEC's disclosure
yeah.
proposal that's due in a couple of weeks. And I applaud the SEC for giving us some more time. I, as a risk management, practitioner, I don't mind a regulator telling me what they expect. But where I begin to have some challenges are regulators telling me how to achieve what they expect.
Hmm.
And so, one of the things that I think, um, will be interesting to see how the SEC proposal evolves, and we'll see if it actually changes from the final to what was proposed. But I'd like to see the regulators land in a place where they explain what it is they would like to see, but don't mandate how we get there,
Hmm.
right? Because I
Yeah.
think then that begins to um, cut off that opportunity to evolve, to innovate, to get
Mhm.
better. And who's to say that the SEC knows, right? Who's to say that any regulator really knows
Mhm.
how to, create the optimal
Right.
outcome?
Yeah. Yes, as smart as they are, and as many things as regulations provided us, at the end of the day, like you said, that you're the ones, the institutions are the ones who are in the business. They're the ones who are accountable for the failures. They're the ones who have to answer to the shareholders and to the creditors. So yeah, there is a valuable need for that type of communication and collaboration. So. One thing I've been holding back asking, but I can't go without asking it, is I understand that you have your own podcast within the bank. Can you tell me a little more about it?
Sure. No, I thanks for asking, and it's been a total pleasure. So we have a podcast called Between Two Regulators, and it is co-hosted with a buddy of mine, Penn Tran. He's currently the head of regulatory relations at Capital One. But Penn and I actually started at the Richmond Fed at the exact same time back in 2004 as safety and soundness bank examiners. And we developed a friendship over the years. And he joined Capital One about 3 years ago now, maybe 2 years ago. He's head of regulatory relations, and our objective is really to pull back the curtain of the examination process, to empower associates to understand when we talk about regulators what we mean. And I found that, so I've been at Capital One now for almost 10 years. And what I found is that we have a number of Capital One seems to recruit for better or for worse, and actually I think it's for the better, but a lot of managers and associates who've never worked for a bank before. So they've never been regulated. And so, understanding, the regulatory framework can be an empowering um, event for them.
Mhm.
And if after an engagement with an associate or an executive, where we've walked them through, what it really means to, receive a first day letter, respond, what are some of the quote unquote tricks of the trade? How do you engage with examiners? And to watch their blood pressure lower,
Mhm.
I mean, it's such a personally rewarding thing for both Penn and I. And so we approach that podcast with sort of that lens, and it's something that we're both really, really excited about.
That's great. I will have to try to get a copy from you at some point to listen and
Thank you.
maybe steal some secrets for this own series.
Well, no,
Uh,
Matt, this has been wonderful, and
yeah.
thank you so much for having me.
Yeah. Well, Robert, thank you again for participating in the Credibly Challenged podcast. And I want to extend a thanks to our audience that we really appreciate you taking the time to listen to these insights and hope you have learned something from Robert, yet another distinguished risk executive.